How do investors use a pro forma to analyze investment properties? Imagine you're looking at a property and trying to figure out if it will make you money or drain your resources. That's where a pro forma comes into play. It's like a financial map that shows you the potential of an investment property before you buy. Investors use a pro forma to see if a property can help build wealth over time. It combines current data with future guesses about income and expenses. This helps you see the net operating income, which is the income left after paying operating costs, and the cash flow, or how much money you actually keep after all expenses. To create a pro forma, you start with estimating the gross rental income. Think about what you could charge if the property is fully rented at current market rates. For example, if similar units rent $4,000 to $1,000 a month, that's your starting point. Then, you subtract expected losses from vacancies or rent defaults. If you think you might lose about 5% of rent due to vacancies, you subtract that from your gross income. Next, you list all operating expenses. These include repairs, property management fees, property taxes, insurance, and mortgage payments if you're financing the property. After subtracting these costs from your income, you get the net operating income. Investors use a pro forma to compare different properties or financing options. For instance, they might model what happens if vacancy rates increase to 10% or if rent prices go up by 5%. This helps see how resilient the investment is under different conditions. They also test different mortgage terms, like changing the down payment or interest rate, to see how that affects cash flow and overall returns. Another key use is planning for future growth. Investors can project how making improvements to the property or increasing rents might boost income and property value over time. They also use the pro forma to communicate with lenders or partners, showing a clear picture of how the investment could perform. For Black homeownership and building wealth through real estate, a pro forma is especially helpful. It helps avoid overpaying for properties and finds those that will generate steady income and appreciation. By understanding the numbers, investors can make smarter choices that lead to long-term wealth. In practice, an investor might estimate rental income at full occupancy, subtract vacancy losses, then list annual repair costs, property management fees, taxes, insurance, and mortgage payments. They then calculate the net operating income and projected cash flow. Adjusting variables like rent increases or vacancy rates shows how stable the investment is. This process helps pick properties that will generate income, build equity, and grow wealth over time. In short, a pro forma is a vital tool that guides investors through analyzing, comparing, and managing investment properties. It helps make informed decisions, maximize returns, and support long-term wealth creation, especially in the context of building generational wealth through real estate.